Silver doesn't need to trend on social media to change the rules of the market. It only needs to cross one number that forces everyone to react at the same time. That number is 100, because once a market prints triple digits, psychology flips, liquidity shifts, and positioning gets forced. Not slowly, not politely, all at once. And here's the part that should make attention snap into place. In early January 2026, widely circulated reporting describes silver trading around $94 an ounce, up roughly 34% in January, and more than 200% over the past year. Read that again. More than 200% in a year, and still pushing higher. Another report framed the move as nearly 29% in roughly 23 days, with silver getting close to 100 per ounce for the first time in the modern narrative. Whether every headline detail is perfect or not, the market behavior is the signal. This is a breakout story now, not a background story. Pause for a second, because the most dangerous moment in a market is when the crowd realizes something late, then tries to make up for lost time. 100 is not important because it's the correct price. 100 is important because people act like it's a line between worlds. Below it, silver is a commodity. Above it, silver becomes a macro asset. And when that switch flips, volatility doesn't just increase, it changes shape. Here's what needs to be understood before the chart even comes up. There is no single silver price. There's a reference price, and then there's reality. There's spot, the benchmark for immediate settlement in the wholesale world. There's futures, standardized contracts on exchanges that dominate the headline price people quote. And there's physical, the actual metal moving through refineries, mints, industrial supply chains, and retail channels, with premiums, delivery delays, and real-world friction. Most of the time, those three lanes move together closely enough that nobody cares. But during a surge, the gaps matter. The gaps can widen. The gaps can scream. So a 100 breakout is never just about a clean candle above a round number. It's about whether the system can absorb demand without breaking its own plumbing. Stop, because this is where conventional wisdom gets it wrong. The popular story says silver moves on vibes. Fear, hype, memes, wild squeezes, that's the surface layer. Underneath, silver is a hybrid market with two engines pulling in different directions: monetary sensitivity and industrial necessity. Monetary sensitivity means real interest rates, the dollar, liquidity cycles, and risk appetite can whip the price around. Industrial necessity means silver gets consumed in applications that don't care about social sentiment. Known uses where substitution is difficult, performance matters, and the metal isn't optional. When those two engines align in the same direction, the move can be violent. And a 100 level is exactly the kind of milestone that brings both engines into the spotlight. Now, anchor this in history, because silver has a long memory, and the crowd does too. For decades, the psychological ceiling for silver has been around 50. The famous peak in 1980 is often quoted near 50.35 to 50.36, and the modern era high in 2011 is widely cited around 49.80 on an intraday basis. That 50 zone became a cultural boundary, the top of the chart, the level people think of as the limit. So a run toward 100 isn't testing the old high, it's doubling the old ceiling. That's why the behavior around 100 matters so much. It's a regime question. Is the market simply overshooting on momentum, then snapping back into the old world? Or is the market repricing into a new world where old ceilings become floors? That's the real question. And it has a real answer, but not a comfortable one. The answer is found in mechanics, not opinions. Start with futures because futures dominate price discovery. Futures markets run on margin. That means control of a large position requires only a fraction of the full value posted as collateral. Leverage creates liquidity, and leverage creates fragility. In a rising market, leverage feels like rocket fuel. In a sudden downdraft, leverage becomes a trapdoor. This is why a 100 breakout can be followed by a brutal pullback, even if the long-term thesis is strong. It's not contradiction, it's leverage math. And there's another lever: margins can change. If volatility spikes, exchanges can raise margin requirements. Brokers can raise requirements too. That forces traders to post more collateral to hold the same exposure. When traders can't, they're forced to sell. Forced selling can cascade into sharp drops that look irrational, but are simply the market liquidating leverage. Now connect that to a round number like 100. A round number attracts attention. Attention attracts participation. Participation increases volatility. Volatility increases margin pressure. Margin pressure forces liquidation. Idation creates violent candles. That feedback loop is why silver gets dramatic exactly when it becomes interesting. So the cleanest way to think about the 100 zone is not as a single line, but as a decision range. A true breakout usually looks like this: a push above, then a pullback, then a hold, then acceptance. The market has to prove it can absorb selling at the level, because selling will show up at 100. Some selling is profit-taking, especially from buyers who watched silver climb for months and suddenly see life-changing gains. Some selling is systematic: trend funds rebalancing, volatility targeting, risk parity adjustments. Some selling is hedging: producers, refiners, industrial users adjusting exposure. And some selling is psychological: people who waited years for a big number to exit. So, if silver tags 100 and immediately falls back into the 90s and stays there, the market is signaling rejection. If silver pushes above 100, dips, and buyers defend the level quickly, repeatedly, the market is signaling acceptance. Acceptance is what changes the story. Acceptance is how a round number becomes a floor. Now bring in the macro lens, because silver is never just a commodity when it moves like this. Silver responds to real rates, rates adjusted for inflation expectations, because real rates shape the opportunity cost of holding metals. Silver responds to the dollar, because global commodities trade in dollars and dollar strength can tighten financial conditions. Silver responds to liquidity, because liquidity is oxygen for risk assets and metals can behave like a liquid macro instrument during stress. But silver also responds to industrial demand, and that's the part that makes the 100 conversation different than a pure monetary trade. According to the Silver Institute's World Silver Survey reporting, industrial demand rose 4% in 2024 to a record 680.5 million ounces. At the same time, the market was described as running a structural deficit of 148.9 million ounces in 2024. That's not a minor imbalance, that's the kind of persistent draw that slowly eats buffers and increases sensitivity. Another widely cited figure from that same research ecosystem puts total demand around 1.16 billion ounces for 2024. So even if investment flows swing wildly from year to year, the underlying consumption base remains enormous. Let that sink in. Hundreds of millions of ounces demanded by industry, and a market that has already been leaning on above-ground supply to balance. In a market like that, price becomes the rationing mechanism. When demand is steady and supply can't instantly surge, price is what clears the market, and silver supply is not as responsive as people assume. A large portion of silver production is byproduct, coming alongside mining of other metals. That means even a big jump in silver price doesn't automatically trigger an immediate flood of new supply. New mines take time, new projects take capital, permitting and development take years. Production doesn't just pivot because a chart looks exciting. So when industrial demand grows and supply is slow to respond, deficits appear, inventories get drawn down, and the price becomes more sensitive to shocks. Now, add the technical layer but keep it grounded. In strong momentum phases, the price can stretch far above long-term averages. One widely discussed example from the recent surge describes silver trading around double its 200-day moving average during the run, which is an extreme condition that often precedes either a sharp correction or a period of sideways consolidation. That doesn't mean the move is fake. It means the move is hot. And hot markets do two things. they attract late buyers, and they punish late buyers. Here's a simple truth about breakout markets. The first time a big number gets touched, it often triggers a battle. Why? Because the crowd is split into two camps. One camp sees 100 and thinks this is the top. The other camp sees 100 and thinks this is the beginning. Both camps can be wrong in the short run, and that's why silver can whip both directions before a trend becomes obvious. So what confirms that a 100 breakout is real? Price behavior is one piece, but structure is the deeper piece. Watch the futures curve. In commodity markets, contango means future prices are higher than spot, often normal due to storage and financing costs. Backwardation means near-term prices are higher than longer-dated prices, often signaling urgency for immediate supply, or a market that's tight enough that the front end is being bid aggressively. A market can rally in contango, purely speculative, purely liquidity-driven. But when a market begins showing tightness signals, especially around the front month and nearby spreads, it suggests something more than a chart story. And then there's physical premiums. If physical premiums rise while futures move, that can indicate real-world demand outpacing immediate supply availability in certain channels. Premiums aren't always a clean indicator because retail and wholesale dynamics differ, but premiums can become a useful lens when combined with other signals. So the 100 conversation becomes a checklist. Does price hold above the level? Do dips get bought quickly, or do they drag? Do spreads and structure hint at tightness, or remain relaxed? Do physical channels show stress, or remain smooth? Now, the gold-silver relationship adds another clue. When silver outperforms gold, the gold-to-silver ratio falls. Historically, that ratio has spent long periods around ranges often cited near 65, though it can swing widely. During the recent surge, reporting highlighted a gold-silver ratio near 51, meaning silver was strengthening relative to gold, not just rising in isolation. That matters because silver often lags gold early in a metal cycle, then catches up violently later. When silver starts leading, it can signal a momentum phase where silver becomes the preferred vehicle for metals beta. But again, that doesn't guarantee continuation. It increases the probability of volatility. Now, the bearish case clearly, because ignoring it is how counts get wrecked. First, a 100 approach can be a blow-off. When an asset runs hundreds of percent and then accelerates into a milestone, the odds of an air pocket increase. Even strong markets can drop 20% in days when leverage unwinds. In silver, those drops can happen faster than the news can explain. Second, margin changes can trigger forced selling. If requirements rise into a hot market, weak hands get flushed. That flush can cascade, and it can happen even while the macro thesis remains intact. Third, macro risk-off can crush everything. If the dollar spikes, if liquidity tightens, if a credit event hits, silver can get sold alongside risk assets. In the short run, correlations can rise to 1. That's not silver failing. That's liquidity stress. Fourth, 100 itself can be a magnet for sellers. Big round numbers attract profit-taking and hedging. The higher the visibility, the more supply can appear at the exact level people celebrate. Fifth, policy and market structure changes can alter behavior, exchanges can adjust rules, regulators can tighten oversight, large players can shift hedges. The silver market is smaller than many asset classes and can be more sensitive to these shifts. So a 100 breakout can fail, a 100 breakout can trap late buyers, a 100 breakout can overshoot and then unwind. That's all true. Now, the bullish reinforcement but without fantasy. Those risks don't erase the structural backdrop. A market with record industrial demand and a documented deficit posture has a different foundation than a market floating on hype alone. The demand base is real, the supply response is slow, the buffers can get thinner. When a market like that enters a momentum phase, it can reprice aggressively because the marginal ounce matters more. And that's the word, marginal. Prices are set at the margin, by the next buyer and the next seller. If buyers become urgent, if hedgers get squeezed, if industrial demand is inelastic in key segments, if investment flows surge, The marginal price can move far beyond what feels reasonable. And the moment the crowd realizes silver isn't a sleepy metal anymore, participation changes. Participation is gasoline, and gasoline around a level like 100 can ignite volatility for weeks or months. So the practical question becomes, how to analyze the 100 zone without getting emotionally hijacked. Start with 3 confirmations. First, acceptance above 100. Not a 1-minute spike, not a single daily print. Acceptance shows up as repeated defense of the level, pullbacks that bounce, closes that hold, failed breakdowns, buyers stepping in when it matters. Second, controlled volatility. A healthy breakout can still be volatile, but it tends to reward dips. A failing breakout tends to punish dips. Bounces get sold, supports break, and momentum fades. Third, structure signals. Spreads, curve shape, and physical premiums can offer clues about whether the move is purely paper or whether demand is showing urgency. Now, here's where it gets really interesting. Even if silver breaks 100 and holds, the market can still do something painful. It can consolidate. A hot market often needs to cool. Cooling doesn't always look like a big crash. Cooling can look like sideways action, weeks of chop that exhaust both bulls and bears. That's how markets reset without collapsing. So a strong thesis does not require a straight line. A straight line is actually a warning. The healthiest breakouts often move in waves. Now, the implications for different audiences because the same chart means different things depending on time horizon and exposure type. For traders, the 100 zone is a battlefield, not a victory lap. The key is invalidation. What proves the breakout failed? A sustained move back below the level? A weekly close back into the prior range? A breakdown of a key moving average? The exact rule depends on strategy, but the rule must exist before emotion shows up. Traders also need to respect position sizing. Silver can move multiple dollars in a day at these levels. That's not a meme. That's math. Leverage magnifies mistakes. For long-term investors, the job is separating thesis from timing. A multi-year industrial demand story can be true and still deliver brutal drawdowns along the way. If volatility can't be emotionally tolerated, exposure needs to be scaled. Long-term conviction without risk control is not discipline, it's a bet. For physical holders, the lens includes premiums, availability, and time horizon. Physical markets can behave differently than paper in the short term. Premiums can rise during demand surges. Delivery can slow. But physical holders are still exposed to price swings, and big moves can test patience. For newcomers, the highest priority is avoiding the emotional trap. When price is ripping, the brain screams late. That feeling can trigger chasing. Chasing is how people buy tops. The antidote is process, understanding mechanics, understanding risk, and refusing to confuse excitement with edge. Now, a necessary reality check about numbers. A nominal price like 100 can mean different things depending on purchasing power and macro context. A 50 print in 1980 happened in a specific inflation and monetary regime. A 50 print in 2011 happened in a different regime. A 100 print today would exist in yet another regime. So comparisons are useful but not perfect. What matters is behavior, and behavior around big milestones tends to repeat. Disbelief turns into attention. Attention turns into participation. Participation turns into volatility. Volatility turns into forced positioning. Forced positioning turns into either acceptance or rejection. That sequence is the anatomy of a breakout. Now, focus on what can be verified, because the internet loves narratives, and silver attracts loud narratives. Data exists. Industry demand figures exist, including the record 680.5 million ounce industrial demand in 2024 and the 148.9 million ounce deficit cited in major survey reporting. Historical peaks exist, including the widely cited modern era high near 49.8 in 2011 and the famous 1980 peak around 50.35 to 50.36. Recent move descriptions exist, including reporting that frame silver around 94 an ounce, up 34p, air cent in January and more than 200% year over year, and another report describing a 29% surge in about 23 days toward the 100 zone. Those are anchors, numbers that can be checked and cross-checked. Interpretation is where opinions begin. So the most intelligent way to approach this is to separate facts from inference. Fact: silver has shown extreme momentum. Fact: industrial demand has been described at record levels in recent survey reporting. Fact: the market has been framed as running deficits in that same reporting. Fact: 100 is a major psychological and technical milestone because it represents a regime shift in perception. Inference: whether 100 will hold. Inference: whether the move will continue immediately. Inference: how macro forces will behave in the coming weeks. And that's important because the future is uncertain even when the setup is compelling. So what can be done with uncertainty? Preparation. Preparation means defining what would confirm and what would invalidate the breakout. Preparation means watching structure, not just headlines. Preparation means refusing to treat silver like a lottery ticket. Now, time for the core explanation in one clean chain, because this is the part that ties everything together. A push toward 100 becomes possible when macro conditions support metals, liquidity encourages risk-taking, and industrial demand remains firm, while supply cannot instantly respond. As price rises, breakout traders and trend systems add fuel. As visibility increases, new participation arrives. As volatility expands, margin dynamics amplify movement. As the market approaches 100, sellers and hedgers appear, creating a battle. If buyers absorb that supply and defend the level, acceptance forms. If acceptance forms, 100 can turn from resistance into support. If that happens, the market's mental model shifts and the next wave of flows can arrive. That's the breakout mechanism, a blend of psychology, structure, and supply-demand constraints. Now, the most important warning, delivered plainly. A market can be structurally bullish and still punish impatience. Silver can reverse violently. Silver can gap. Silver can overshoot and then whip back. That risk is not a footnote. It is the nature of the asset. So any approach to this market needs humility, and it needs guardrails. Now, 3 takeaways to lock this down, clean and usable. First, 100 is not a prediction, it's a decision zone. A 100 print alone is not confirmation. Confirmation is acceptance, defense, the market proving the level matters in both directions. Second, fundamentals explain why silver can stay elevated, but fundamentals do not remove volatility. Record industrial demand and deficit figures provide structural context, but leverage and liquidity cycles can still create sharp pullbacks. Third, verification and risk control matter more than excitement. Watch price behavior, watch market structure, watch for signs of acceptance versus rejection, scale exposure to match volatility, avoid COA, infusing a headline with a plan. Full risk disclosure. This is educational information, not financial advice. Markets are uncertain. Silver is highly volatile. No outcome is guaranteed. Independent verification matters, and position sizing is essential. And here's the final thought to carry forward because it captures the entire moment. If silver breaks 100 and holds, that's not just a new number on a screen. It's a signal that the market may be entering a faster, more chaotic phase where old assumptions fail, and only disciplined analysis survives. It's not about being early, it's about being prepared before the next wave hits, and not after